So with that, I will.
Great, thank you, Tina. So the first three panelists are really focusing on the benchmark, risk to the benchmark. Max is obviously trying to find those companies within the benchmark that are going to be that unique hole, if you will, for the fish he's trying to get. Scott now is a very different perspective. I think a lot of people, if you just said, what is an active manager? People might think about how Scott approaches things. That is, he's really looking at those companies. He's trying to really dig in the weeds and understand what, company A versus B, C, and D are doing. And so, Scott, why don't you talk a little bit about your approach and what you can add to this?
Thank you very much. Actually, I wanted to lay a theoretical background for the discussion. Personally, I was involved in modern portfolio theory near the inception. A lot of the work was done in the mid-'60s, and I did quite a bit of work on math models of portfolio theory at a school back east about 1970, 71. I actually did my thesis in this area. So let's look at the relative merits of active investing versus passive. If you look at the academic literature, in 1965, Eugene Farmer, and he's very important because he coined the term the random walk. He was an assistant professor of finance at the University of Chicago Business School. He published his seminal work, Random Walks and Stock Market Prices. Farmer addressed both technical analysis, and for those of you who may not be familiar, when you watch CNBC or Bloomberg and they put the chart up there and it's supposedly breaking out, that's technical analysis, and also fundamental intrinsic value analysis. Using S&P stock data from 1929 to 1959, Farmer concluded that technical analysis was totally bogus, proving that successive stock price changes were statistically independent events. Similarly, using the same data set for common stocks from 1926 to 1960, he found that fundamental analysis lacked merit. Hence, the concept of the efficient market. There are numerous buyers and sellers, equal access to information, no monopoly power, and then when new information comes into the marketplace, prices adjust instantaneously to a new intrinsic value. Now, we've talked about William Sharpe earlier. Sharpe similarly used what he called the efficient market hypothesis with his capital asset pricing model, saying that if you have given an identifiable volatility of beta, one could forecast expected return versus a benchmark. And of course, when CalSTRS indexes against the Russell 3000 or the Russell 2500 value or the 2000 value of the emerging markets, they take on a certain beta and they think they're going to get a certain expected return. Well, this was all very good, except that there were other academicians out there that refuted this, including Farmer himself. So I want to start with two major studies. The first one was in 1980. It was Mark Reingenum in the Journal of Financial Economics. It's a scholarly article entitled Misspecification of Capital Asset Pricing. I'm just going to give you the gist of it. We're not going to go through the mathematics because these are complicated articles. Employing stock price data for the period 1962 through 1975, Reingenum grouped stocks into deciles from lowest PEs to highest PEs, and that he found that the lowest PE decile earned an abnormal return of 4.5% per annum. Then he split the data into deciles according to market capitalization size and found that the smallest decile group posted a 12% abnormal return. Ergo, capital asset pricing is not accurate. 1992, Eugene Farmer left the cold winters of Chicago to come out to Stanford University on a sabbatical. And he worked with an associate named Kenneth French, and he revisited his own random walk theory. With stock price data from July 1963 through December 1990, Farmer French also formed decile categories from smallest market equity to the largest equity capitalization size. He found that the average returns for small cap were 1.64% a month, while the largest capital decile only 90 basis points, a huge gap of 74 basis points per month in return. As a corollary, Farmer found no relation between average return and beta, which contradicts Sharpe. And this is very important when you're trying to target, as you did, an asset mix and you have asset classes. Beta against an index is inaccurate. And this actually work was done by Eugene Farmer, who is the founder of the random walk. Then they looked at data from 1963 to 1990, and they ranked stocks in decile by price to book value. And the average returns rose from 0.3% monthly for the highest price to book decile to 1.83% per month per price to book decile, 1.5%. So he rejected his own random walk thesis. The bottom line is there are inefficiencies in the market. So let's talk about practical application for somebody such as CalSTRS. While the academic literature supports the deep value approach that we do with smaller capitalization size, low P and low price to book, you can naturally ask the question, why should you pay for active management if you can index the Russell 2000 value? Firstly, as both Ranganam and Farmer concluded, the beta in the capital asset pricing model is not an accurate predictor of expected returns. Additionally, with bottom-up research such as what we do, where we talk and visit with every company, we do quantitative and qualitative analysis, we can identify better companies in the small mid-cap universe versus the omnibus approach to indexing. We screen for higher ex-ante growth in revenues and earnings, stronger returns on equity and total capital, better free cash flows and balance sheet than those in the index. Additionally, because we are active, we can examine individual companies for litigation and something that's near and dear to you, we had earlier, corporate governance issues. Most important, with our valuation discipline, we purchase these better businesses at substantial discounts to the index multiple. For example, today, the Russell 2000 value and the Russell 2500 value indices sell at approximately 17 times this year's expected earnings, while Delphi has an uppermost purchasing limit, doesn't matter what the stock is, of 13 times expected earnings. So we're buying better characteristics at far lower multiples. Now, it should be noted that excess returns can also be earned by other active investors who pursue intensive research. For example, there have been two prominent Boston growth stock managers you've probably heard of. One was Peter Lynch, and the other was Kenny Hebner. And they produced outstanding returns over long cycles. An examination of other styles, which I did in preparation for the meeting, indicates that there are other active managers in the non-value categories, like small cap growth, multi-cap core, mid-cap growth, and health and biotech stocks that have superior records. And one of the critical roles of the CalSTRS professional staff is to identify these overachievers based on their historical records and consistency of approach. Now, you can make the case, perhaps, that you should index, but I have some recent studies on that as well. There was a major study that came out by S&P, was published in Forbes for the 5-year period ending in 2012. And yes, 65% of the large cap managers lagged the S&P 500, but that means that 35% outperformed. That's the job of the professional staff. You can say 80% of the mid-cap managers lagged the S&P 400 mid-cap, but there were 20% that outperformed. And in the small cap universe, 77% of small cap lagged the S&P 600 small caps, means 23% outperform. So there are active management, and it's not like 1 and 2%. It's not minuscule. There are people out there that can beat the benchmarks. So the one final caveat I want to make on passive investing, which is highly noteworthy. If you look at the policy portfolio of CalSTRS, and I was told in the literature they sent me, as a whole, you're benchmarked against the Russell 3000 index. If you look at the last decade, from January 1st, 2000 through December 31, 2009, we experienced the worst stock market returns for the major indices in U.S. history, even worse than the 1930s. An index fund of the Russell 3000 posted a 2% loss with dividend reinvested for that period. An extraordinarily large pension fund such as yours cannot be content with the aforementioned return given from the numerous plan participants. The only alternative to transcend a terrible decade is to select active managers who can far outpace the averages.
Great, thank you, Scott. So, John, I think one of the criticisms of passive management is, and I'll use an analogy today about a restaurant. Let's say you read all the reviews, knew this restaurant was great, even had some friends who went there. It's a little cheaper and it's better than average. The only caveat is you got to try everything on the menu and you got to order in a certain quantity that you couldn't control. So as an investor, like someone with a dining experience, you have your own unique tastes, you have your own unique desires, and when you can customize things, it sometimes can help. So as a passive manager, what is that? What is the problem there with being able to just take everything that's handed to you?
Well, I think I'd kind of turn the question on its head, if you will, that in the sense that the reality is the responsibility of the active manager is to take, like you said, the a la carte menu and say, I'm not going to order the sea urchin or whatever, right? But the point being that, let me back up a little bit here, that the one common argument for active management is that, hey, I'm nimble, I have the ability to, in certain market situations, perhaps divest into cash, for example, to lower my market exposure, or conversely, have a higher market exposure than cash. Than the equity market. The reality is that is still predicated on that manager having skill. That, for example, if you look at, the report you all put together in terms of how your active managers perform, for example, in 2008, that I'm actually looking at the table on page 7 here, that looking at the performance of your active managers, and I think it's most appropriate to focus on the core managers because those in aggregate most closely reflect your benchmark of Russell 3000 ex tobacco, that active managers in aggregate actually underperformed the benchmark in that period when the market was actually going down. And I apologize for trotting out the SPIVA data again, guys, but when you look at the performance of active managers in 2008, and again, here, I'm not gonna eat the sea urchin, right? I have the ability to, shimmy and shammy and make tactical adjustments that, again, across large cap, mid cap, small cap space, that again, in that year, 65% of the active managers underperformed their respective index benchmarks. One other comment to the point that, and yeah, certainly, obviously, like you said, kind of the 1 minus X point that you said that, for example, there's 25% of the managers, say, over some certain time frame beating the benchmark, that what that really does is really raise the barrier for you as a plan sponsor to pick those managers with skill. Can I pick a good guy 53% of the time? Maybe, but to even break it even using that scenario, you'd have to make that choice correctly 75% of the time. And I would argue that's a very, very high bar to hurdle.
Jump in.
So you raise first of all, thanks for the 3 against 1 thing that I appreciate that. So you raise a really important issue, I think, in the scope of active management here. We wrote an article back several years ago, which was entitled something to the effect of, when active management is not a zero-sum game. The reality is that, we all don't want to pick off the menu in the same way. Compare CalSTRS to a sovereign wealth fund. What's your risk tolerance short-term like relative to what that sovereign wealth fund's risk tolerance should be? You should be able to trade in a way with a sovereign wealth fund, in theory, to be able to say, actually, we can both make each other better off. Sovereign wealth fund is happy during a time of financial stress to be able to take on risks that you may not be able to bear. That makes you better off. That makes the sovereign wealth fund better off because they're going to get paid for doing that. So there are instances like that. Hedge funds who, during periods of stress, find themselves having to sell distressed assets at distressed asset prices, to somebody else because they've got stop losses and other conditions that they have to work with. So the point that I would make here is that when you get to the broadest level of asset management, you can find the greatest differences between investors, and you can find the greatest opportunities for actually making all parties better off. The more narrowly you define the scope of the active management, so begin to make, for example, take large cap equities. Let's constrain the manager to being sector neutral and style neutral, and let's begin to box them into very, very narrow sorts of ranges on the individual stocks. You've taken away a lot of the ability to go out there and find alpha where they're in fact differential investors trading with each other. That's a really tough game. That's why I think Scott is a much better investor than I am, because he's playing in a space that's very difficult and succeeding in that. I'm playing in a space where not a lot of competitors are doing what we do. So the more we box active management in, the more difficult it is for sure.
I just wanted to make one comment. You said, okay, 08 people got hit. People like me, we didn't get killed with the tech bubble, but let's take large cap value. We talked about the Russell 3000. Let's take the S&P 500, another big broad base. There are plenty of indexes on the S&P 500. That was a terrific decade. It was up 4.4% with dividends reinvested. If you took out the dividends, it was negative. If you've got assets and liabilities and you've got to pay pensions for the teachers fund, you can't make the case that that was good. In all due respect, we were up, even with the pullback in 08, we were well up by over 100% in that decade versus 4.4%. Essentially, any large plan that was dependent on paying out distributions to, to their retirees got murdered in the last decade.
Let me go back to let me go back to that very table on page 4. There were 2 market crashes represented on this table, and one is 2008, where the fund underperformed, but there's also 2000 and 2001, where the fund actually substantially outperformed. I would suspect, and this is conjecture, that you were probably more indexed in 2008 than you were in 2000, or was there more index representation?
I think in 2000 we were about 80-20 active
Okay.
passive. So we
Okay,
had
so it was
little
less?
bit, less passive.
Okay.
In 2008.
But the point is, we have to be careful in how we choose years, because there is also a period in which the fund did fairly well. But let me just finish. The other thing, which again sort of picks up on what Max said, is the decline in the level of active share among active managers. In the Petayista and Kramer study, it showed that between the 80s and the 90s, those funds defined as high active share, meaning really active, basically, dropped by about 70% during that period. So obviously that's fairly large. And there are 2 things, one major thing that coincided with that, and that is the sort of popularity of the 9 style box framework, in which managers were sort of then boxed into, in order to not have style drift, they had to, in essence, constrain themselves. And I suspect that led to the decline in active share among managers, and also the decline in the return experience. And then the final thing I just want to respond to, this is NBA season. And, there are very few elite players that get to play in the NBA, and very few that get to, the final game. And it just strikes me that, but there are elite players. And so to then say, let us, in essence, dispel with the game of the NBA league, because most of us would probably not qualify to get there. Doesn't seem to make a lot of sense. There is talent. Talent, like any other sort of human endeavor, is probably distributed along a bell curve with the average folks in the middle, the people that have no insight on the left, and the people that have insight on to the right. So the job of your very able staff and myself is to find those people.
I think Mr. Rosensteel has a question.
Thank you. So this is really very interesting, and it gives a lot of insight. We've heard two different opinions about Bill Sharp today. 30 years ago, I was a student of Bill Sharp's, and he just one class. I can't say that I was, he was my PhD thesis advisor. I was an MBA student. I took a class in investments from him. But I do remember a couple of things that he said. And one was he told the story about his mother calling him up and saying, Bill, what should I invest my money in? And he said, Mom, I don't know. And she said, what do you mean you don't know? You're this world-famous investment theorist. Well, if you don't know, who does? And he says, that's the point, Mom. Nobody knows. And so his point is not that there aren't, at least my recollection was, not that there aren't inefficiencies in the market. There are. Not that there aren't active managers who beat the market. There are. But how do we pick them? How do we know? And I think this is what John said. Was how do we know who they are going to be, and how do we know that we're going to be able to, on average, pick the winners, who on average are then going to pick the winners when they make investment decisions? And that's what I think the whole question kind of comes back to. And to be honest, I mean, if Bill Sharp wasn't smart enough to pick them, I'm not sure who is. I think he's a smart guy. So that's I think the question that I'd like to hear addressed, because it's not just, doesn't seem to me to be just smart people. There are lots of really smart people who made a real killing in the market for certain periods of time, and then market changed, and they lost a lot of money, as your statistics show. I mean, maybe it is, a lot of it is cyclical. So that's the question that I have.
Tina, why don't you start off with that, because that's exactly what you're trying to do. And Paul, just to add a little finer point to that, not only do you have to pick the right managers, but you have to give them the right proportion of your portfolio. And sometimes you even have to give them the right proportion at the right time, depending on what the market conditions are. So Tina.
The first thing I would say is to stop emphasizing the statistics that most of us emphasize. And those are the backward-looking statistics, such as 3-year and 5-year alpha, information ratio, the quartile graphs, all that stuff. And the reason is that they've universally been shown to, first of all, have very little predictive value as to future performance. And secondly, they're all incredibly susceptible to mean reversion. So I would, I don't remember the name of the author, but there is an interesting study done that looked at the actual return experience of mutual funds versus the return experience of their investors. And I think the difference was about 2%. And the reason is precisely because of selection processes that were based on those kinds of statistics. So that's one thing I would advise. The second is, again, while yes, that the concept has been challenged recently, but I do believe that at least for fundamental sort of bottom-up managers, perhaps not Max's firm because it's a different kind of process, but to focus on active share because that statistic has been shown to be A, persistent, and B, predictive. And so I would focus on active share. And then I think the question is, do you really understand what inefficiencies this manager is trying to profit from, and are you confident in, based on sort of who they are, their team, their processes, et cetera, that they can successfully mine those inefficiencies. But the main thing, I think the standard selection criteria, particularly the quantitative criteria, have done the investment industry a disservice in that they've led to mean reversion.
Thanks, Tina. So Max, just building on this a little bit, as you analyze the data, and I know you dig deep into factors and you're looking at every sort of inefficiency or opportunity set that's in the data in the market, going back as far as you possibly can, and then sometimes you probably relook at it at a different time period and other things. I know we've talked about this a lot. But to Tina's point, if we're too focused on the rearview mirror statistics, based on what you see in the market, are there enough opportunity sets for an investor like CalSTRS to realistically be able to pick a portfolio of active managers that can take advantage of that opportunity set? You know, is it large enough? And, you know, let's assume we get some talented managers and, you know, things like Tina does or whatever a process is that is designed to pick talent. From your perspective in the data, is the opportunity set there?
Yeah, so it's a very good question. Let me run with something Tina said and follow up because they're actually connected here. I might have answered the question in a very similar vein as Tina did, but I would start from a different place and say, well, for me, it's a lot like what I do in terms of trying to pick winning factors. When I'm looking in the historical data, so just by way of background, what we do is we think about how markets work, and then we look into the data to find ways to reflect those ideas and then examine whether they in fact do work. So we look at data to prove our case about the investment ideas. We find lots and lots and lots of ideas if we just look at the data that seem to work. In the same way that you could look at a manager database and find lots of managers that, at least over a short run, seem to work, seem to be performing. Really all comes down to making judgments then about it. And Dave's approach is he puts us in a hot room with a bright white light and drills us deeply about questions. I have to say, one of the things that happens with our good clients is we talk about performance. But the vast majority of the conversation is about, well, why this? Why this? How about this? It's a digging and it's an examination of the robustness, the quality of the ideas that the manager is bringing in to bear. And so it's an art form at the end of the day in terms of deciding how to find managers. It cannot be a quantitative exercise. It cannot be. Quantitative exercise tells you who to invite to the table because you're not going to hire anybody that hasn't performed. But that's not enough to hire somebody. You've got to dig. Now, are the opportunities at the end of the day big enough? My observation would be that yes, they absolutely are. Now, I'm going to speak strictly from a top-down perspective. Maybe Scott's got some insights when you think about this more from a strictly bottom-up perspective. We see big cycles in what happens in terms of the opportunity sets. I did see opportunity sets seeming to shrink as we got into the period pre-2007. In a lot of respects, in the macro area, it seemed like opportunities were getting a little bit thinner. They're back out to being big again. Now, part of that might be, to the point that John has made, is there's a lot of people that have become increasingly passive in what they do, and I'm thankful for that. And John, I want you out there as much as possible talking about that, because the more passive players there are, the more that those active, inefficiencies open up. So when I look at this from a 30-year perspective, Well, let's take us all the way back into the 1970s. Actually, if you go back into the 70s, the opportunity sets that we saw were huge. They came down a lot in the 1980s. And they fell and rose again in the 1990s, and they're back up today to what we saw in the 1980s. So yes, I think there's a lot of opportunities for the kinds of things that we look at least from a top-down perspective today, that seem to disappear for a moment or shrink too much for a moment.
Okay. Well, the academic literature, which I don't know whether you're Harvard or Stanford, because Sharp left Harvard. Stanford. Yeah, I know. I actually, right. You know, Jack McDonald, I actually gave a lecture in his course about the inefficiencies in the market a couple of years ago. Anyway, the academic literature shows that ipso facto, the one place mathematically you can beat the dealer is low P's and low price to book. Doesn't mean other styles don't work, but that's been shown over and over again over a long serial data thing. But what do you need? This goes along with what Tina says. You want asset managers, not asset gatherers, because she's absolutely right. Is people take their record on the road and they keep marketing so they make more money instead of shutting down. We shut down years ago. People are spending too much time on marketing and not enough on research and portfolio management. That's the other thing. The most important thing is, yes, you look at ex post and hope you're going to get ex ante returns. But what your staff has to do is look at the stated philosophy that produced the ex post results. You have to have it specifically outlined and make sure that in the future it's totally congruent with the stated philosophy that brought you. If there's deviations, or if an organization gets too big and they're moving up in capitalization size, or if in the old days they were absolute value players and now they're growth at a reasonable price, the process that brought them initial success is going to deteriorate. So what your staff has to do is check for goal congruence against the stated philosophy that produced the good results.
John have an opinion about this?
John?
Yeah, I guess what I'm trying to convey at the end of the day is this idea of humility, in the sense that there is this tailwind, right, that active managers face, and that there's issues in terms of portfolio construction, for example, that you mentioned. Okay, well, how much capital can I allocate to the different managers? Again, I just come back to the basics. You guys have $45 billion to manage in domestic equity. That, like you suggest, that perhaps smaller managers or more niche managers, there may be some opportunity set there. But again, at the end of the day, how are you going to put that entire portfolio to work? And I'm going to suggest that, like now, the preponderance of that money is going to be on the index side of the fence rather than the active side.
David, I since we could probably go on for an hour, how much time do we have for this, or
Really, this is your discussion. It's going to be ongoing. You know, as we know, we're probably going to come back in the fall. This is, as you said, we could go on for days. So we're not going to keep you here for days. We want to get your points answered. I want to
ask one more question that should take 2 minutes if people answer the way I ask it, which is, just give me a number, each of you. What percentage of our $45 billion should be actively managed?
I'll start 70-30, 80-20. I mean, I agree with you. I just don't think it's either or.
Okay. Well, yeah, I'll concur with the 80 index, 20 active.
I think it's hard to come up with a number for that, quite frankly. If you think about it as a percentage of your active risk budget, though, you probably want to be somewhere in the 5+% range if you're going to make a difference. CalSTRS has sort of the good and the bad here in that they're very sizable, and it is going to be hard to find enough managers to make all of that active. I agree with that point. On the other hand, CalSTRS has the advantage of being able to hire a professional staff that a lot of investors can't, so that they can look into this and develop judgment, develop skills in-house to look out-house, as well as being able to have insights about which managers will add value. It's a big advantage. And so even while it may be a smaller percentage of the fund in terms of the amount of active management, that's still hundreds of millions of dollars of potential value added.
Percentage?
Max, he wants a number.
Yeah, so that's a notional number. So in the way that people run this today, it's going to be in the 30% range. It depends on the risk levels you're using.
Well, again, it depends on how hard you want to work your staff. But I think realistically, I mean, if you look at expected returns on stocks over time, and I paid attention during your long-term asset liability. Stock market has not done even 8.5% and 9% compounded over the last few years, and depending on the data you look at from 1946 forward, segregating periods, sometimes it did 11.5% compounded, some did 8.5% compounded. We're just talking about U.S. equities as a portion, not even putting fixed income, and you have an obligation out there. It would seem to me, if you can find active managers, we'll have higher ex-ante returns than the market as a whole. And with your liability, I would consider that if you can find alpha. So on a $45 billion portfolio, 40% is $18 billion, 50% is $22.5 billion. I don't think that's unrealistic. Obviously, you're not going to be able to put much of it into the small cap space because it's more difficult, but you can certainly put it into the low PE and low price to book. And so if you want to capture higher ex-ante returns, I think active management is the way to go.
Okay, I think I'm going to try to wrap it up there, right? This has been very useful, very valuable. I know that the board members here very much appreciate it. You're coming out and participating in this panel. I'm sure Chris made it aware to you that we probably have this on recording and other people are witnessing it as we speak. And I'm sure the board members who unfortunately were not able to attend today for different reasons will probably review this material, and others will, because it's readily accessible on our board sites, and we really appreciate the information you presented here today. My final comment was going to be that I think it goes down, at least for this organization, that it comes down to not only staff, but a very rigorous process, just like the rigorous process that we would expect our active managers to have. And so that's one thing that I didn't hear mentioned, but I think that that's very key to this organization going forward as we either maintain or expand our exposure to active management or reduce it. Anyway, thank you so much for this presentation. It was terrific. Thank you. Okay. I think we're going to be able to hopefully wrap this up fairly easily. The next agenda item is review of information requests. Do you recall any specific?
I have two things. One was that you'd asked staff to report back on the comments that Unite here made concerning the Hyatt Regency and PCCP. And the other thing I have is regarding the asset liability study. PCA and Mr. McCoy are going to bring back a better display of the potential distribution outcomes and viewed over a longer time horizon, 10 plus years.
Thank you, Lamont. I appreciate you summarizing those. Paul or Frank, do you recall anything else? Harry, I forgot about you. You didn't get to ask any questions. I hope you're there.
It was a fascinating panel. I really appreciated listening. Really very good. Well done.
All right. Any The next agenda item, item 16, draft agenda for the July 9th, 2013 meeting. Any comments by board members? Yes, Chris.
I just want to let you know, it is going to get revised. Item 4 and 5 look virtually identical. But item 4, which will really be the first one, will be the asset liability study you saw today. Whenever we do that, we also then usually follow up with you changing the investment policy to incorporate the new ranges. What we'll try and do is do it at the same meeting so that at the time you vote on those options, then it'll follow up. The next item will be to just take those options and incorporate them into the policy. There are also a few other revisions we need to make to the overall investment policy. And then I had a request from Board Member Sharon Hendricks to add an item to talk about issues management relating to the stuff we talked a bit about in closed session, which is how can the investment office do a better job of informing you of the work we're doing on different issues. And so we'll try and figure out if we can put an agenda item together to at least bring that to the forefront.
All right. Thank you. All right, the last item is the opportunity for statements from the public. Is there anyone from the public who would like to make a comment? Seeing none, this meeting is adjourned. Thank you.